Well, what does the current market turmoil mean for retirees and pre-retirees? To discuss that in terms of financial and non-financial impacts, Justine Marquet from Allianz Retire Plus joining us now. Justine, good to see you.
Thank you, Andrew.
All right. Are retirees and those approaching retirement feeling just a bit nervous at the moment, given that volatility, and obviously that would be impacting in particular their super?
Yes, I think they're definitely feeling nervous. That's definitely the information that we're seeing on the ground with advisors working with retirees and also with super funds working with their members. The risks that retirees face are more significant when it comes to volatility like this.
Yeah, particularly if you're at the stage you're about to sort of draw down on those investments. So given what you do there at Allianz Retire Plus, how are you managing that for these retirees and pre-retirees in terms of guiding them?
So we suggest, an alternative, approach to retirement to what people have traditionally taken, a more evolved approach that involves de-risking the portfolio somewhat by investing in a future income stream, a guaranteed lifetime income stream. But that investment, whilst it allows for upside growth, it also provides some downside protection, which is particularly important in the lead up to and those early years of retirement where we have significant sequencing risk. The sequencing risk is at its highest at that time, where retirees have their bulk amount of money, probably the most savings they'll ever have.
So you're emphasising capital preservation, and to do that
with part of the portfolio,
right?
Yeah. So by de-risking part of the portfolio and offloading that to an insurer by investing in a future guaranteed income stream, what the client's doing is de-risking the volatility of the part of their portfolio that they've put aside for that stable, reliable income in retirement that can cover the basic expenses, and they can then keep the remainder of their money invested in the growth investments that they're going to need in order to see their portfolio be sustainable for the rest of their life.
If they opt to become more defensive, perhaps more conservative in their investment strategy, then what are the potential impacts of that?
It depends how you define conservative, I guess. I think if they generally just move to more conservative assets overall in the portfolio, that's problematic, of course, particularly once the horse is already bolted, like now. Once the markets have already become volatile, we don't want to lock in the losses, of course.
Well, and you only have to look at where the market is now. It's almost back to where it began.
So I think there's an opportunity, I think, to try and plan a little in advance by undertaking some of this de-risking of the portfolio in the lead up to retirement. Getting wholly conservative, as we know, won't provide the growth that retirees need, particularly given their longevity in Australia. We're one of the longest lived nations in the world, so people need growth in their portfolios to make sure those portfolios last and provide them an income for that period of time. But there's no doubt that retirees are also looking for some security and reliability of income that they know they can depend on in retirement.
So can you give us some examples of those products that would be on offer for them?
Yeah, so for example, with Allianz Retire Plus, we offer a product called Agile, which is Allianz's guaranteed income for life. And that's a deferred annuity style product where people can invest now. They can invest with their super money while it's still preserved if they wish, or outside of super with money that might be sitting in the market or in a term deposit. And those investments, while they can be linked to an international or Australian equity index, also have some built-in downside protection, either a partial level of downside protection or full downside protection. And that can then, if we're apportioning part of the portfolio to that investment, might be somewhere around 20 or 30%, then that helps to offload some of that risk. And then when they're ready to retire and turn on the income, they turn on the income, and that income is then paid on the grown balance, whatever that amount has got to, and it's then paid for the rest of their life. And the income's guaranteed never to decrease, and it will only increase if that selection is taken, that option is taken, or it can be fixed income for the rest of their life. And I think that having that in the portfolio as sort of that foundational income, so they know they'll always be able to manage their costs and their expenses, and then the other money being their play money or for their estate or whatever they're looking for, legacy. I think that can be a new approach, a sort of more contemporary way of looking at portfolio construction. And I think one of the important things to mention is that no longer with these products, certainly with Agile, are you giving up access to your money. So the client gets a daily balance. They always understand what their investment value is, and they can always get access to that.
Do you find many retirees are unaware of those options available to them, particularly securing a stable sort of financial income, if you like, in terms of an annuity and the like?
Yeah, I do. I think in Australia, these sort of innovative income streams are just emerging now and gaining some traction. Certainly, we've seen it uptake in interest, of course, this year. But a lot of these innovative income streams have been in market for just a few years. But our experience overseas, particularly in the States where this product was modelled from, shows us that these are highly valued strategies and products, and we saw the biggest uptake of that initially in the States when the GFC happened over there all those years ago. And now it's a massive market for us. Allianz sells billions of dollars of annuities every year in that market and in Europe. So I think it's just a matter of time before Australians and Australian financial advisors get their head around these kinds of things.